Very respected and eminent speaker of this evening, CA Prashant Bhojwani, Secretary of SIRC, CA Panaraj, senior members and friends, very good evening to all of you. Today, the advent of new areas of professional opportunities have made us to realize that challenging task is ahead, and at the same time, glorious future is waiting for our profession. Today, we are considered as a business solution providers and financial advisors. So we have to equip ourselves for all the areas of our professional practice. Keeping this in mind, we as SIRC are organizing various industry-specific program for the benefit of members. One such program is today's program. Today, we have with us one of the great speakers, CA Prashant, to speak on the topic of direct tax landscape for the media and the entertainment industry, including the emerging issues with regard to the particular industry. This industry itself very, very interesting. So subject also will be very much interesting. On behalf of SIRC, I welcome the speaker of this evening and thank him for accepting our invitation and addressing us. The most importantly, I welcome all the members who are attending this program. Our eminent speaker will highlight the various aspects in direct tax for this entertainment industry for the benefit of members. Maybe we are in for an enlightening evening today, and I am sure that everyone would add to their thoughts on the subject immensely. I once again extend my warm welcome to the speaker and all other participants. With this, I request CA Panaraj sir, Secretary of SIRC, to introduce the speaker of this evening.
Thank you, Chairman, for setting the tone. Good evening, all. I take the pleasure of introducing Mr. Prashant Bhojwani, who was one of the most sought after speakers across, but for the first time he is speaking on SIRC DAS. A warm welcome to you once again.
Thank you.
He has worked across direct tax specializations, corporate tax, international tax, personal tax, transfer pricing, transaction tax, besides foreign direct investment policy and exchange control regulations. This includes advising clients on investment structuring, both inbound and outbound, corporate restructuring, cross-border transactions, succession planning, business model optimization, compliance and litigation matters. He specializes in serving clients in media and entertainment industry, including broadcast films, digital media. His select experience includes structuring film deals, inbound shoots, outbound shoots, both foreign and Indian films, business model optimization, advising on global acquisitions for media and entertainment players. He has authored several articles featuring in journals, publications, print and digital media, and has also been a speaker at various conferences, events on tax and media and entertainment sector related topics. He has been appointed to the National Committee on Media and Entertainment of the CII for 2015-19 term. With this, I once again welcome the speaker and hand over the session to you. Yes, sir. Please take
on. Thank you, Chairman. Thank you, Secretary, and good evening, everybody. I hope everybody is keeping safe. Let me just start with the presentation.
Yes, visible, sir.
Okay. One second. Has the slide changed?
No, sir. It's still in the media industry. First page. Maybe you might have passed the screen. You can see in that. If it is passed, you can click on it and it will resume. You can stop and reshare it again if you wanted.
I'll just do that.
Now you can share it. No, you pressed the wrong button, so you turned off it.
I've purposely kept my just switched off the video. Let me start the presentation, then I'll switch it.
Okay, sir.
Silva, can you share the screen because my slides are somehow not moving.
Take 1 minute. So I'll just share it from my end.
Yeah.
Selva, otherwise you can operate the PPT. You have?
So I'm gonna share it. So 1 minute. Just give me a time. I'll just. 10 minutes back it was working, so that is.
Yeah. So we can go to slide 2.
Yes.
Okay. Straight deep diving into the presentation. Now, the media and entertainment industry is extremely diversified. Okay. If we see the number of segments which is part of the media and entertainment industry, one, we have the traditional segments which are broadcast, print, and radio. And at the same time, we also have the new age segments, which is digital advertising, digital media, and online gaming. Now, broadcast has historically always been the largest segment under media and entertainment industry in India. But a lot of other segments, the new age segments, are growing fast and catching up. Now, if we look at the impact of the pandemic on the media and entertainment sector, there's been a varied, the impact has been in a very varied manner. Okay, we see films and print, which has really had a negative impact. At the same time, if we look at digital media and gaming, actually, the pandemic has facilitated the growth of these sectors, and now these are the fastest growing sectors under media and entertainment. Yeah, next slide. So content is now we move on to the tax issues. Okay. Content is really the core of the media and entertainment industry. Okay. And there are various business models whereby content is acquired by the broadcasters and the OTT players. Okay. The first model is the in-house production, where the content is produced by the broadcaster. The second model is where the content is produced by the production house as per the specification of the broadcaster or the OTT player. And the third model is whereby only the broadcasting rights for the content are acquired. Now, under the first two models, IP to the content, IP to the hello. IP to the content is owned by the broadcaster or the OTT player, while under the third scenario, the IP is not owned by the OTT player or the broadcaster. Now, the withholding tax or the TDS implications really depends on the business model. And each business model, the withholding tax implication is different. The CBDT, the Central Board of Direct Taxes, that is, has in fact clarified in terms of the withholding tax implications. Now, if we look at the model 2, where the content which is produced as per the specification of the broadcaster and the copyright of such content vests with the broadcaster, it has been clarified that it is covered by the definition of work under section 194C. Now, work is defined under section 194C. Now, work is defined to include broadcasting and telecasting, including production of programs. So, under the business model 2, it is covered by 194C, and hence the withholding tax of 2% will be applicable. Now, if we look at our in-house production, each and every respective payment has to be looked into to evaluate the withholding tax implication. For example, if a payment is made to an actor, withholding tax of 10% under 194J can apply. Next slide, please. Now, from content production, we move over to content amortization. Content is the most significant expenditure for broadcasters and OTT players. There are no specific rules prescribed under the income tax laws in terms of the manner of allowability of content for broadcasters and OTT players. Well, there are rules which are provided for film producers, which we'll deal with later. So, in terms of commissioned content, generally content is treated as inventory by the broadcasters, and it is debited to the profit and loss account in the first year of telecast. Now, the issue which arises is the year of allowability of content. The taxpayers have historically been following the practice of claiming it in the first year of telecast. Now, there have been few cases where the tax authorities have not agreed with the taxpayers' position. And what the tax authorities have done is they've considered this as an intangible asset and allowed depreciation at the rate of 25% on this content. However, finally, the issue has been settled at the tribunal level in the assessees, in the taxpayers' favor in most of the cases. Yeah. Some of them are, I think Sun TV was one of the first cases which really came up at the tribunal on this issue. Okay, next slide. Now here we are dealing with the overseas channel. Now it is quite common for the Indian broadcasters, to have their channel broadcast in overseas countries, considering the huge dysphoria of the Indian population across the globe. Now, here we have an Indian broadcaster, and the channel is beamed in an overseas country. Now, there are certain specific expenses which the Indian broadcaster would be incurring for the purposes of beaming the channel in the overseas country. Now, the key issue out here is when the payment is made by the Indian broadcaster to the overseas service provider, whether it is transponder fees or any other payment, whether the said payment is deemed to accrue or arise in India under the domestic tax laws, and accordingly Indian withholding tax, whether it's applicable or not applicable. Okay, next slide. Now, this achieves a lot of significance, particularly in tax protected contracts, because what happens is if it is taxable and the contract with the overseas service provider is a tax protected contract, then this is going to be is really a additional tax cost sitting on the broadcaster for the broadcaster. Now, if we look at the domestic tax laws, there is a specific exclusion from royalty and fees for technical services. Now, when a payment is made by a resident to a non-resident, okay, in respect of any right used for the services utilized for the purposes of business carried on outside India. So the key is business carried on outside India, or for the purpose of earning any income from a source outside India, then it is not taxable, and as a consequence, withholding tax is not applicable. Okay. Now, the core issue really out here is whether the payment is made for a business carried on outside India or for earning an income from a source outside India. Okay. Now, if the answer is yes, okay, to any of them, then it would not be taxable and withholding tax would not be applicable under the domestic tax law. Now, if we really have to evaluate this issue, there is no straight answer. It will depend on various facts. For example, whether where are the advertisers located, where are the subscribers, viewers. Now, what is the kind of content, or where is the content procured from for broadcasting on the channel, whether there is a physical presence in that overseas country, where are the activities which are carried out, including uplinking, downlinking, whether there is a common beam for the overseas channel, for the Indian channel as well as for the overseas channel, whether the transponder is common. Various facts have to be looked into. Now, there is a recent decision in case of NGC of the Mumbai Tribunal. This, of course, is on the reverse situation. Here we have a foreign telecasting company which is broadcasting its channel in India. But some of the observations are very helpful. Okay, where the telecast of the channel happens from outside India, all the other core activities such as procurement, aggregation of the content, editing, uplinking are conducted by the SSC from outside India. So this is exactly the reverse situation for us. Now, if we apply the analogy from the NGC decision, it would be very difficult really to say that the source is outside India. Okay, because the broadcaster, essentially all the activities, everything, business is is being done from India, so the business essentially is being carried out from India. But now let's say if some of the facts are different, like if the Indian broadcaster has a branch in the overseas country for the purposes of its channel, from where the business is being done, then the answer to this could be different. You can move over to the next slide. Yeah. Now we are dealing with the case of OTT player in terms of content aggregation. Now, if we look at the facts, we have an Indian OTT player. They procure the content from a Singapore company. Now, the content is actually owned by a US company. So the US company licenses the content to a Singapore company, and the Singapore company in turn sub-licenses the content to the Indian platform owner. Now, some of them could be group entity, could be related parties, and then group entity transactions. Now, when we look at the tax implications, okay, we need to look at it at two legs. First, let's look at the implication for the payment made by the Indian platform owner to the Singapore company. Okay. Here, we will look at the India-Singapore tax treaty, and as per the India-Singapore tax treaty, this would be considered as royalty and taxable at 15%. While we look at the Act, the tax rate for royalty is lower, would be lower, it would be 10%. So the Indian platform owner would have to withhold tax at 10% plus surcharge cess on payments to the Singapore content aggregator. Now, the Singapore content aggregator would not be required to file its return as long as this is the only source of income for the Singapore company and appropriate taxes are withheld. So now this is the first leg of the payment. Now we look at the second leg of the payment, which is Singapore company making the payment to the US company. Now this is in fact a very interesting issue. Now for this purpose, we will have to look at the India-US tax treaty. The reason being, we are evaluating the taxability of a US company, okay? And India will apply the India-US tax treaty. We can move to the next slide. Now, under the India-US tax treaty, the royalty article has a second source rule. Okay, and what the second source rule essentially says is that royalty which relates to the use of property in one of the contracting states, in this case India, okay, the royalty would deem to arise in that state, which is India, which is 12(7)(b). Now clause A basically deals with the accrual of royalty where the payer is a resident of one of the states. It would not accrue under clause A. Hence, we look at clause B. Under clause B, it accrues in India. Okay, so it is for use in India, and the payment made by the Singapore company to the US company would be taxable in India. Okay. Now we have looked at the nature of payment in the hands of Singapore company. Now we are looking at the nature of payment in the hands of the US company. The nature of payment essentially is the same, but the manner of taxability will be different. Okay. For under the US treaty, okay, one is we apply the treaty for the US company, it would be taxable at 15%. Okay. Now under the Act, okay, we would not be in a position to apply section 115A because this is a transaction between two non-residents. Okay, so section 115A does not apply. Okay, given that section 115A does not apply, okay, the normal provisions of the Act would apply, whereby US company would be taxable at the normal tax rates, which would be 40% on a net income basis. Okay, and the US company would also be required to file its return in India. There would be no exemption in its hands. Okay, now given this, we can just see the contrasting manner in which two companies are taxed, the Singapore company and the US company. Of course, the US company has the option of still going under the treaty and being taxable on a gross income basis at 15%, but they cannot apply the 10% qua its taxability. Now, there is one issue which is purely from a withholding tax perspective, whether the Singapore company can still apply section 115A only for the purposes of withholding tax. Okay. Now this is an open issue, though taxability essentially would still happen under the normal provisions or under the treaty, which is 15%. Next slide. Now we move over to celebrity shoutouts. Now this is a recent trend. Here the end users or the customers can actually get obtain personalized videos from celebrities. You know, it could be birthday greetings, etc. So if you look at the parties which are involved, there would be a celebrity which could be Indian or overseas. There would be a customer which could be located in India or overseas, and of course the platform. Now the payment flow would be as follows. The customer would make the payment to the platform and the platform would make the payment to the celebrity. The customers can download, view and share the videos. Okay. However, the copyright in terms of the video will always vest with the platform owner. Okay. Now what we have to do is we have to examine the withholding tax implications on payment made to foreign celebrities. So the payment would be made by the platform owner to the foreign celebrity. For the celebrity, it is an income. So generally, the celebrity would be, could be an actor. He would essentially be an entertainer. Okay? For the celebrity, it is essentially income from performance of a service. Okay, for this purpose, we'll have to look at Article 17 of the relevant tax treaty. Article 17 deals with the taxation of entertainers. And in principle, what Article 17 really says is that it is taxable in the other state if if the personal activities are exercised in the other contracting state. Now, in this case, let's see what happens. The foreign celebrity is not exercising any services in India. Okay. The video is shot overseas. It is only viewed in India. Okay, and as the services are not provided by the foreign celebrity in India, it would not be taxable under Article 17, and accordingly, there would be no withholding tax on such payments. Okay, next slide. Now we move to equalization levy. Equalization levy essentially arises out of the BEPS project, which is the base erosion and profit shifting project. This project essentially wants to address the shifting of profits to low tax jurisdictions. This is driven by the OECD. It's a global project, and India is an active participant at the OECD for this project. Now, equalization levy initially was introduced in 2016, which only covered payments for overseas ad sales. Okay, overseas payments for digital advertising. Now, the scope of equalization levy has been expanded in 2020. Okay. Equalization levy essentially deals with the taxation of the digital economy. Under Equalization Levy 2020, it also now covers online provision of services by the e-commerce operator. Okay. Now here the levy is on the non-resident. Okay. In contrast to the Equalization Levy 2016, wherein the compliance obligations essentially was on the resident payers. Here the non-residents are required to make the payment of equalization levy and undertake the necessary compliances. Payments which are subject to equalization levy, okay, the income would be exempt in the hands of the non-resident e-commerce operator. Now, Equalization 2020 really essentially has an impact on several segments in the media and entertainment industry because it largely deals with the digital economy. Content streaming is one, online gaming, subscription of e-journals, e-papers, they all are impacted by equalization levy. Now, there is one key aspect which needs to be looked at when we are examining this such issues. There is an interplay between taxation under royalty, fees for technical services versus equalization levy, and also significant economic presence. So all of them, when we are evaluating digital transactions, the interplay between all of them needs to be looked at, because ideally it is only one levy which as such should be applicable and not more than that. Next slide. Now, film industry has had a very tough time, over the past year because the theaters have been shut. There have been several restrictions in terms of shooting new content. If we look at areas for monetizing a film, over the last 10 years, you can say there are, it's the avenues for monetizing a film has really expanded. There are several avenues which are available. Okay. Domestic box office, of course, has traditionally been always the largest revenue source for the film industry. Now, if we contrast it to the Hollywood industry, okay, the Hollywood industry, in fact, earns more revenues from the international box office than it earns from its own domestic box office. Okay. Several new trends really have cropped up over the last year. Now we have films and content which is specifically being created for with the OTT players in mind for the digital media. Now, if you look at in film advertising, now in film advertising is essentially product placements in films. Now, a couple of examples we can discuss. One is if you recollect the movie Doom 3, the BMW logo was shown very prominently. Okay, uh, that is nothing but an in-film advertising. Okay, so the BMW logo being shown in Doom 3 is an example of in-film advertising. Now, a couple of other areas we should also discuss is licensing and merchandising. Now, for the Hollywood industry, licensing and merchandising is a huge money spinner for some of the franchises. If you look at Star Wars, Harry Potter, there is huge amount of money which is earned from licensing and merchandising. Now, if you look at the potential uh, for the Indian films, there is still a huge amount of potential for monetization in terms of the other areas which are still available for us. Next slide. Now, dealing with film production. The special characteristics for filmmaking has been recognized under the domestic tax laws. There is a specific framework or guidance for amortization of film production costs. Okay. Rule 9A deals with the special rules for deduction of expenses for film production. The first time these rules were introduced was way back in 1987. Okay. Now, Rule 9A applies in addition to the other provisions of the Act. The first time special provisions were introduced for amortization of film cost was way back in 1937. Okay, where there was an amortization policy which was laid out for film production costs by way of a specific circular. Okay. Now, 9A, as I said, has been introduced in 87, and there have not been much amendments other than the change of the period. Essentially, the deduction depends on two aspects: the extent of exploration of the film and the date of release. In principle, deduction is available in the year of release. Okay, if the film is released 90 days prior to the end of the financial year, entire cost of production is allowable. If the film is released less than 90 days prior before the end of the financial year, then deduction of cost of production is allowable to the extent of the amount realized by exhibiting the film on a commercial basis. Now, the term cost of production has been defined under the rules. Now, one key issue which really comes up for interpretation is what is the meaning of the term amount realized by exhibiting film on a commercial basis? Whether it includes theatrical, or does it also include other avenues such as satellite, OTT, or any other avenue? Okay. Now, as I said, the rules were introduced in 1987, and at that point in time, largely there were limited avenues for exhibiting a film. Theatrical was primarily the only avenue. Now, this issue has come up in various cases. Okay, and essentially the court has held that with the advancement of technology, okay, the scope of releasing films has changed. Okay, and it should not now be restricted only to theatrical and should cover other avenues such as satellite also. So even if the movie is released on satellite, it should be covered by Rule 9A. Next slide. The royalty definition has been amended in the year 2020. Okay. Now, before we move over to the amendment, let's just step back and see what the situation was prior to the amendment by Finance Act 2020. Okay. Under the definition of royalty, in Section 9, there was a specific exclusion, but not including consideration for the sale, distribution, or exhibition of cinematographic films. So let's see the impact of this. The impact of this was the amount which was the consideration for sale, distribution, exhibition of cinematographic film was not considered as royalty, and hence TDS and withholding tax was not applicable. Okay, this was the position prior to up to Finance Act 2020. Post 2020, this exclusion has been taken away. So now what happens is this constitutes royalty. Okay, and the typical royalty rate is 10%. Okay, but along with this amendment, there is another amendment which was made under Section 194J, okay, which deals with technical services and royalty. A clause was added, so 2% of such sum in case of royalty, where such royalty is in the nature of consideration for sale, distribution, or exhibition of cinematographic films. Now, if this clause was not inserted, then because of Finance Act 2020, the royalty withholding tax rate would be 10%. But there is a benefit which is given. This clause was inserted and the withholding tax rate was capped at 2%. But if we see the overall impact, has been an adverse impact on the film industry as cash flow issues, as the entire cash flow across the value chain gets impacted by this withholding tax rate of 2%. And the impact would be quite severe in case if the films have not done well. Okay, because across the value chain there will be a withholding tax of 2% at each and every leg. Next slide, please. Now we move over to a Hollywood film which is shot in India. Okay, so let's look at the facts of the case. We have a foreign company which produces a Hollywood film. The film shooting takes place in India. Now, for the purpose of film shooting, we have foreign actors, crew, producer visit India. Equipment is also rented from overseas. Okay. Now we have to examine the taxability in the hands of the foreign film producer, the actors, the crew, and the equipment rent, and the taxability for the equipment rentals. Next slide. Now, just to give you a perspective in terms of how complicated the tax implications in a cross-border film shoot can get. Okay. The film producer would be a US company where the intellectual property would vest. Okay, as I've shown, India is where the film shooting takes place. Now the actors come in from UK, the crew comes in from Canada, and the equipment is shipped in from Germany. Okay, so we need to evaluate the implications for various parties and from various countries. Okay, now first starting off with the film producer. Okay, under the domestic tax, and just before we start, okay, you know, over the last 5-7 years, or rather last 5 years, the Indian government has they've been focusing on promoting India is a destination for shooting films. There are various foreign films which have been shot in India. If you look at some of the prominent ones being Kung Fu Yoga, Second Best Exotic Marigold Hotel. There are roughly 30 to 40 foreign films shot every year in India. Okay. Now moving over to the taxability part, the film producer. Under the domestic tax laws, there is a specific exclusion. Income of a non-resident through or from operations confined to shooting a cinematographic film in India is not taxable under section 911D. Now let's examine the applicability of this. Okay, whether it is applicable to a film producer. One. Second is it applicable only to a film producer, or can it be expanded to other parties also, such as a crew? Okay, so there are two issues to be dealt with. If we look at the language of in the domestic tax laws, it nowhere refers to the term film producer. Okay, it says through or from operations confined to shooting a cinematographic film. Okay, but when this section was introduced, if we look at the explanatory memorandum, the heading clearly brought out it stated exemption of foreign film producers. Okay, so the first thing is clear that it is applicable to foreign film producers. Now the second, whether it can be expanded to other service providers, I would say no, for two reasons. The first reason being, as I said, the heading specifically states foreign film producers only. Okay, and second is, when the section was introduced, it was introduced in 1984. Parallelly, there was another section which was introduced for section 10(5)(a), which provided an exemption for services in connection with shooting. Now, that section was omitted in 1998. Okay, but ideally, that section covered the services provided by the non-residents for the film shooting. Okay. So now coming to the exemption, there are two aspects to be looked at for the applicability of the exclusion. One is the party to which it applies. Okay. There are certain conditions which are applicable. For example, the foreign producer should, if any of the shareholders of the foreign producer is an Indian resident or an Indian citizen, then it would not apply. Okay. So one is the parties need to be tested. Second is the activity. As we see, it is confined to shooting of a cinematographic film. So if there are any other activities which are carried out, then the taxability needs to be separately evaluated. Okay. Now from film producer, let's move on to the actors. Okay. Actors are essentially the people in front of the camera whom you see on the screen. Okay. Taxability of actors is covered by Article 17 of the relevant tax treaty. Okay. Now, in principle, what does Article 17 do? Okay. And why do we have a special article for taxability of entertainers? The reason being, internationally, it has been accepted that, there are special provisions required for taxability of entertainers because of the kind of activities which is being carried out by them. They are extremely mobile. Okay. Uh, because of that, a specific article has been inserted. Now, the first time a specific article was inserted for taxability of entertainers was way back in 1939 in one of the US tax treaties. Okay. Now, Article 17 of tax treaties, essentially it grants the right to the country of performance. Okay, in short. So here the film shooting has happened in India. Okay, so as per the relevant tax treaty, the taxability rights are with India. Okay? but the article does not specify the manner of taxability in the source state. Okay, so for the manner of taxability, we need to fall back on the domestic tax laws. Okay, under the domestic tax laws, we need to see section 115 BBA, which deals with taxability of entertainers. Okay, one very important point is 115 BBA deals with taxation of non-resident entertainers who are not citizens of India. Okay. For the purpose of taxation under this section, number of days stay in India is really not relevant. Okay, so if a non-resident actor comes to India and shoots for just 1 day, he would still be taxable in India. Uh, a withholding tax of 20% would apply plus surcharge cess on payments made to the actor. Okay. Now, if the actor is not earning any other source of income from India, this is the only source of income, then and if appropriate taxes are withheld under this section, then the actor does not need to even file his return of income. Okay. Another important aspect is the income tax clearance certificate. The actors need to obtain an income tax clearance certificate from the tax authorities before they leave the country. Okay. Now, so the foreign film producer is not taxable in India, but in spite of this, he is required to undertake the necessary compliances. For example, the withholding tax. On payments made to actors, he is required to withhold tax and deposit that with the Indian government. For that purposes, he'll have to obtain a TAN. Now, moving over to the crew. Next slide, please. So crew essentially are people behind the scene, okay, who are not seen in the film. Well, they could be stuntman, they could be a film director, or any other person who's really helped with the film production, but is not part of the film which is seen on the screen. Now, for taxability of the crew, various aspects needs to be looked into. One is the nature of service provided. Now you'll see the nature of service is going to be very vast. Now there could be a makeup artist as well as there could be a stunt. So nature of service is important. The entity form of the payee, whether it is a company, whether it is an individual, or whether it is a partnership firm. Next, the number of days stay in India and the tax treaty provisions. Now the crew could come from various countries. Okay? So the India's tax treaty with each country could be different as far as taxability of crew is concerned. Okay. Now, if the payment is made to a company, okay, then we need to evaluate Article 12, which deals with fees for technical services. That is consideration for managerial, technical, or consultancy services. That's whether it falls within that. That's the first aspect. Second, there could also be a make available clause in that relevant tax treaty. So that narrows down the taxability. Now, Article 14 deals with taxability of professionals who are not employees. Okay. So it includes taxability of professional fees which are artistic as well as other independent activities. Now, in case if any of the conditions below 3 conditions are satisfied, that is, the person does not have a fixed base in India, his stay in India is for less than 183 days, and his remuneration is not derived from a resident in India or is borne by a permanent establishment of the non-resident in India. If all these 3 conditions are satisfied, then the crew would not be taxable in India. Okay, so all these conditions need to be satisfied for non-taxability. Okay, in this case, the payment to the crew will be made by the non-resident. Okay, and the non-resident typically should not have a permanent establishment. And another important point is not borne by permanent establishment. So what is the meaning of that? So essentially the meaning of that is that it should not be claimed as a tax deductible expenditure in India. Okay. So if all these conditions satisfied, then the payment made to crew is not taxable in India. Now coming to the payment made to employees, because some of the crew might be employees. Okay. So then we need to evaluate the article dealing with dependent personal services. Article 14 was dealing with independent personal services. Now under Article 15, the remuneration paid to employees, okay, is not taxable, again, if the following three conditions are satisfied. One, the stay in India does not exceed 183 days. The remuneration is paid by or on behalf of a non-resident employer, and the remuneration is not borne by the employer's pay in India. So if all the three conditions are satisfied, then the payment made to the employee would not be taxable in India as per Article 15 of the India-Canada Tax Treaty. Now, along with this, we should also look at the domestic tax laws. Under the domestic tax laws, there is a short stay exemption for payments made to employees under Section 1066. Now, the difference there is that it has a shorter time period, which is 90 days. And one key difference under the Act for short stay exemption vis-a-vis the treaty is the short stay exemption is not applicable to Indian citizens. So an Indian citizen who would be a non-resident cannot claim a short stay exemption under the Act. He will necessarily have to fall back on the treaty. Okay. So under the treaty, if these conditions satisfied, then the employees would not be taxable. In case if the conditions are not satisfied in Article 14 or 15, as the case may be, the crew would be taxable in India. As a consequence of that, the producer, while making the payment to them, will have to withhold tax and deposit the tax with the Indian government. One, the non-resident crew would be required to file its return in India, and also an income tax clearance certificate will have to be obtained by them before they depart India. Now, next slide. Now coming to the last leg, which is taxability of equipment. Now this is quite an interesting issue, really, because taxability of equipment, there could be various scenarios, okay, depending on the relevant tax treaty. One, we can have a scenario wherein India does not have a treaty with the country, with the payee country. Okay. Second is the treaty has an equipment royalty clause along with the second source rule. So the second source rule is what we discussed in the context of the content aggregation. Okay. And the royalty essentially, the royalty clause has two legs to it. One is the normal royalty taxation, the copyright royalty taxation, and second is the equipment royalty taxation. So the second scenario is where equipment royalty clause is also there and a second source rule is there. Third scenario is where we have a royalty, equipment royalty clause, but there is no second source rule. The fourth scenario is where there is no equipment royalty clause under the tax treaty. And the last scenario is the payee, the equipment service provider. I think, sorry, just slides have gone missing. The equipment service provider has a P in India. Okay, so there are the five scenarios which can be applicable. Okay, and the taxability would really depend on each of the scenarios. So it is possible in some of the scenarios is taxable, and the producer will be required to withhold tax on payments to the non-resident for equipment rental, while in some scenarios it would not be taxable. So if we look at this case, I think that, in these possible five scenarios, under scenario 3 and 4, there is a possibility to argue that the payment should not be taxable in India for equipment royalty. Now we've dealt with each of the issues in terms of shooting a Hollywood film in India. Now, what can also happen is the entire film need not be shot in India. Only a part of the film will be shot in India, and the entire film could be shot in, say, let's say 3 countries. Okay. Now, because of this, the complexity really increases. Okay. Because what happens is the actor is going to be taxable in India for the India shoot. Okay. So we need to determine the India income, India sourced income. So in a simpliciter situation where the entire movie is shot in India is okay, but if the movie is shot, film is shot in multiple countries, then the scenario can get further complicated. Next slide. Now we deal with a triangular tax case. Okay. Here we have B, who is an entertainer. Okay. And we have ACO, which is a company which is essentially owned by B. Now, ACO has been engaged to provide the services of B for an event in India. So there are various overseas entertainers, who have performed in India in events. Now, just to name few of them, Justin Bieber, Bryan Adams, Ed Sheeran. So various famous entertainers have performed in India over a period of time. So their taxability becomes very critical. Okay. Now in this case, we have B, who's the entertainer, okay, who's performing in an event in India, but the contract for performance in India is with ACO. Okay. Now, two issues to be dealt with: taxability of B and taxability of ACO. Now, first, let's deal with taxability of B. Now, taxability of B is on similar lines to the taxability of actors, which we discussed in the previous slides. Okay. Total 100 would be paid as performance fees to ACO. Out of the 100, ACO would pay 60 to B. So when we come to taxability of B, B has received 60. 60 would be its income taxable in India under section 115 BBA, okay, at the rate of 20%. For this purpose, we will look at India and state R tax treaty. State R tax treaty because B is a resident of state R. So 20% of 60 would be his tax liability in India. Okay. That is as far as B is concerned. Now we need to look at the taxability of ACO. Okay. Now B is taxable in India under Article 17(1). Now, for the purposes of taxability of ACO, we need to evaluate Article 17(2). Now, Article 17(2) is an anti-avoidance provision. Okay. And it is applicable in cases where the performance income accrues not to the entertainer but to another person. So in this case, the performance income does not accrue to B, but it accrues to ACO, that is 100. Okay. Under Article 17(2), that entire income would be taxable. Okay. Ideally, if Article 17(2) would not have been there, ACO would have argued no permanent establishment in India and hence not taxable in India. Okay. But because of Article 17(2), ACO would be taxable on the entire income, which is 100. Of course, ACO will get a deduction for the expense payment of 60 to B. So 40 would be its ACO's taxable income, and 40 would be taxable at the normal tax rates applicable to foreign companies, which would be 40. Now, we've dealt with the taxability of eco, okay, but essentially just to give you a backdrop of why this has been introduced, okay. As I said, in an idealistic situation of Article 17.2 was not there, eco would have argued non-taxability based on permanent establishment, okay, and this is what typically historically was done. And instead of 60, the payment made to be could be lower, it could be 10, okay, then that entire 90 would escape taxation, okay. So hence Article 17.2 was introduced, and it is, as I said, more in the it's actually in the nature of an anti-avoidance provision, okay. So that's the backdrop really for the introduction of Article 17.2, where taxable, where the foreign company doesn't need to have permanent establishment in India for its taxability. Okay. Next slide. From Hollywood films, now we come to Indian films, okay, and taxability of Indian films. So here we have an Indian film which is produced by an Indian company. Okay. The film shooting takes place overseas in the UK. Okay. And for the purposes of the film shoot, we'll of course have the Indian producer, the actors visit the UK. Now, ICAI appoints FCO, which is a foreign company, which is a UK company, as a line producer for the UK shoot. And the film qualifies for UK film incentives from the British Film Commission, which we'll deal with in the upcoming slides. Now, appointment of a line producer for the overseas shoot is one of the common, is rather the most common business model which is followed. There are a couple of other business models which are followed. For example, the Indian company setting up a branch or a subsidiary in the overseas country, but that is not very commonly followed. Okay. Now we deal with the tax issues in case of such a cross-border shoot. Okay. Now, before we get to that, India is the largest producer of films globally. India produces close to 2,000 films in a year, okay, and in more than 20 different languages. Several of these films are shot in overseas countries and hence cross-border transactions. Okay, and there are a lot of interesting tax issues which really come out of these cross-border transactions, and we'll be dealing with each of them. The first issue is whether the ICO would have a permanent establishment in India. Permanent establishment in UK essentially will give UK the rights to tax ICO. Okay, if ICO were to have a permanent establishment in the UK, then what would happen is the Indian film producer would have to undertake all UK compliances, one, and also pay UK taxes, which will be a tax cost for ICO. Now, on this issue of having a permanent establishment in UK, typically merely by shooting a film overseas, the foreign company should not, I mean the Indian company, and in this case, just one second. Yeah, sorry. Typically, the Indian company should not have a permanent establishment in the UK only on account of shooting the film in the UK. Okay. But it's best, to get upfront clarity at the planning stage itself when the shooting is being planned. Okay, that's the first part of it. Now, second part is dealing with the withholding tax implication in terms of line producer fees. Okay, next slide. Selva, next. Yeah. So the Indian film producer would be making a payment of the line producer fees to the foreign company for its services. Okay. Now, essentially, line producer fees is nothing but service fees paid for facilitating the UK shoot. It could include logistic related activities. Now, if you have to get down to specifics, arranging extras, arranging security, uh, shoot permissions for the purposes of shoots in UK. All this would be part of the line producer scope. So there'll be a bundle of services which the line producer will provide for the purposes of the film shoot in UK. Okay. There are several decisions of the Mumbai Tribunal and few advance ruling on the issue examining the taxability of line producer fees. And all the decisions have come to a common conclusion that the line producer fees is not it's not a consideration for managerial, technical or consultancy work, and hence it should not be taxable in India. And once it is not taxable, withholding tax implications will not arise. So the Indian company can make payment without withholding any taxes on the line producer fees. Again, this issue becomes very important because if for some reason a withholding tax has to apply, then what happens is it becomes a cash flow issue, because the line producer in turn will be making payment for various shoot related expenses in the UK. And if a 10% withholding tax applies, then he has only 90 left to spend uh, for the purposes of the UK shoot. Okay. Now coming to the other issues. Okay. uh, the first one is the other issue is the UK tax implications for Indian residents. As the film is shot in the UK, we'll have Indian actors visit the UK and perform there for the purposes of the shoot. Okay, and ideally, the actors should be taxable in the UK, similar to the way the foreign actors are taxable in India. The Indian actors would be taxable in the UK, and the Indian producer would have to withhold taxes on payments made to the actor for the purposes of the UK shoot, okay, the UK taxes. Now, the Indian actors are essentially Indian residents, and Indian residents are taxable in India on their global income based on residency. So now we have one element of income, which is the UK shoot, okay, where there has been, which is taxable in India, okay, because in India the entire income of the actor would be taxable, and it is also taxable in the UK, okay. So to that extent, in principle, it's a double taxation. Okay, so in this case, you can evaluate a foreign tax credit. So at the time when the actors are filing the tax return in India, a foreign tax credit claim needs to be made, wherein the credit can be claimed for the UK taxes on his income, which is doubly taxed in India. So because with this mechanism, at least double taxation could be reduced, would be eliminated to the extent possible. Okay. Next slide. Now, coming to film incentives. Okay. First, what are film incentives? Okay. So, film incentives are essentially it's a cash rebate which is granted by the government of the overseas country for shooting in that country. Now, government of various countries are promoting film shooting in their country, and there is a reason for that. There are several advantages or objectives associated with it. Okay, the first, it creates employment in the host country where the film is shot, because the local crew will be used out there. Second is the local facilities would be used. For example, the hotels. The revenues would be generated for the government by way of taxes. But the most important advantage, really, the way the country see it, is showcasing their locations. Okay, this promotes tourism. Okay, if we, I'll give you two examples. One of a overseas movie and one of an Indian movie. Uh, there was a film by the name of Sound of Music, which was shot in a very small town, Salzburg, in Austria. Okay, the film was released in 1965. Now we are more than 50 years past that. Okay, but in spite of that, there are thousands of tourists visiting Salzburg every day to see the locations of the film. Okay. Now, in the Indian context, Zindagi Na Milegi Dobara was shot in Spain. I mean, the tourism to Spain from India has increased multifold post that movie. So the way the country see it, okay, this promoting tourism is the most significant advantage. Okay, and what happens in film incentives is uh, a specified percentage of uh, the expenses which are incurred for production of a film in that country is paid back by to the film producer. For example, let's say UK pays 25% of the qualifying expenditure, and so film incentives is really caught up over the last 10 years, and multiple countries, a lot of countries have introduced film incentives. But this concept is pretty old. It's been prevalent in some of the countries for a really long time. Like if you see Canada had film incentives way back in 1974. Okay, and this is an investment which is made by the countries to promote tourism. Now, and if you look at from the perspective of the film producer, I mean, the biggest advantage of the film producer obviously is, the reduction in the cost of production, because if he's getting 25% of the expenditure back, automatically the cost from 100 goes down to 75. Then, as a supplementary advantage, he will showcase new locations to the audiences. Now, the key elements of film incentives. So each country will have their own film incentive scheme. It's also possible that each region have their own film incentive schemes. For example, in Canada, the regions have their own scheme. Okay. Now, under the film incentive scheme, the key element is a cultural test. Now, some countries do, or it's not necessary that all countries have it, but some countries do have the cultural test, and that has to be satisfied for the purposes of claiming film incentives. Okay, so cultural test is nothing but a point-based test wherein an assessment is made of the link between the film and the host country. For example, a couple of examples is whether the local crew is used, okay, for the purposes of the shoot. Next is whether the tourist locations have been shown in the film, because the host country wants the country to be shown in a nice light so that it promotes tourism. Okay. Now coming to the tax treatment, okay, of film incentives. Under Rule 9A, the cost of production, okay, is to be reduced by a subsidy which is received under a government scheme. Okay, that's what Rule 9A says. Okay. Now, the term used is under a government scheme. Now, the key issue out here is when we say the term government, would a foreign government be included? Okay, because generally if we see the construct of the Indian Income Tax Act, wherever the term government is referred, one would say the government really refers to the Indian government, okay, and not the foreign government. So if we take the view it does not include the foreign government, then this reduction cannot happen under Rule 9A. And there's a recent decision tribunal decision on this, which spells out this exact finding. It's in the case of the Airport Authorities of India, okay, though it's not in the context of film production, okay, which says when it said government, it does not include foreign government. Okay. So that's one part of it. Now, in spite of that, okay, whether can we take a position, or the film producer can take a position that this can be reduced, the film incentive received can be reduced from the cost of production, okay, uh, based on treatment in the books, the nature of the film incentive. The nature of the film incentive, depending on the scheme, essentially is it's essentially a reimbursement and not an income. So this would essentially depend on the film incentive scheme. Next slide. Now we've done with the Indian film also. Now moving over to some of the other aspects which are relevant for the purposes of film production. Moving over to co-production. There is a concept of association of persons. Okay. So association of persons essentially is constituted when two or more parties come together for a common purpose. Now, the definition of AOP is not codified under the Indian statute. Okay, it essentially comes from decisions. AOP is relevant, the reason being because once a AOP is constituted, okay, there are certain tax implications which follow. The first implication is the AOP is taxed as a separate entity. Okay, so the entire income from film production would not be taxed in the hands of the members, but would be taxed in the hands of AOP as a separate entity. Then the payments made inter se between members will not be allowed as a deduction for the AOP. So here we'll have a case where AOP is incurring is taxed on the income, but expenses are not allowable. Then the members, the losses of members would not be set off against the income of AOP. That's a consequence as it is taxed as a separate entity. And the losses of AOP are again going to be carried forward in its own hands and not in the hands of the members. So for example, if only one film is produced, okay, and that incurs a loss, what would be happen? It will be a sunk cost. It will never be utilized because the AOP going forward would not have any income. Next slide. Now, in the context of AOP, there is a clarification issued by the Central Board of Direct Taxes. Okay, the following attributes should not constitute AOP. This, of course, is illustrative, but it serves as a good reference point in terms of when we are evaluating the taxability of AOP. The key aspect really here is a clear demarcation of work, responsibility, and liability between the members of the AOP. Okay, so once that is done, we should not have a situation of constituting AOP. Okay. Of course, the facts and circumstances of each case are to be examined to really come to the conclusion whether an AOP is constituted or not. The above circular was issued in the context of an EPC, which is an engineering, procurement, and construction contract, but it's a useful reference point for film productions because under film production, co-productions are quite common for film productions, and this is something which should be evaluated upfront so that the contracts are structured appropriately and it does not lead to any tax risks from a AOP standpoint. Next slide. Now coming to remakes and biopics. Okay. Now let's take the first part, which is remake. Okay. Here we have a Hollywood film. There's a foreign company which owns the IP of the Hollywood film. Okay. And it's being remade as a Hindi film. So the Indian film producer would obtain the remake rights, okay, for the Hollywood film from the foreign company and make a payment to the foreign company. Now the payment could be a lump sum consideration or it could be a minimum guarantee with an overflow. The IP for the Hollywood film rests with the foreign company. Okay. Now, the foreign company and the Indian film producer could be group entities or third parties. In case if they are group entities, then additionally transfer pricing aspects will have to be evaluated. The payment should be at arm's length and the transfer pricing compliances will have to be undertaken. Okay. Now coming to the taxability. In this case, the Indian film producer would be making a payment to the foreign company for obtaining the necessary rights to remake the film as a Hindi film. Okay. Now, such payments would constitute royalty under the domestic tax laws, and the relevant tax rate would be 10% plus surcharges. So the Indian film producer will have to withhold tax on payments to the foreign company as royalty. Now, presuming this is the only source of income for the foreign company and appropriate taxes are withheld, the foreign company would not be required to file a return of income in India. So that was the first aspect, the remake rights. Now we come to the biopics. Okay. Now, it could be biopic rights or the film could also be based on a book. Okay. Now, if we talk about biopics, over the a recent one is Saina. Earlier, there was Mary Com. So there are several biopics which have been released. An example of a movie based on a book is Half Girlfriend. Excuse. In this case, the producer will have to obtain the rights from the famous personality. Generally, biopics are based on famous personality. We've seen biopics based on sports person. Okay. So Indian film producer will have to secure the biopic rights from the famous personality and produce the biopic. Now, we have to evaluate the withholding tax implications on such payments. Okay. In this case, we presume that the famous personality would be an Indian resident. So, here we have to essentially look at what's the role of the famous personality. Okay, so I would say there are two elements to it. One is the celebrity rights. So the Indian film producer would have to, obtain or secure the biopic rights from the celebrity, which is essentially a celebrity rights. Second is there will be some involvement also of the famous personality. Generally, there is an involvement of the famous personality in during the production of the film in terms of hand holding. For example, the looks in the film should be is generally similar. The style also, it should reflect the celebrity on the screen. And a withholding tax under 194J of 10% would be possible in this case. Okay, considering for the payment made for the celebrity rights by the Indian film producer to the famous personality. Next slide. Now coming to the mergers and acquisitions landscape really. Okay. If we look at the last 3-4 years, okay, there have been several large global acquisitions in the media and entertainment industry. Okay. This is on account of the digital disruption, the convergence which has really happened, and the growth of the digital media. Okay. Some of the examples is the Time Warner acquisition, the Fox acquisition, recently Amazon's acquisition of MGM has been announced, and also the consolidation of Discovery and Warner Media. Uh, in a very short span of the last 3-4 years, we are seeing some of the largest global acquisitions in the media and entertainment industry. So in case of such large acquisitions, we need to look at the India indirect transfer implications. Okay, this is nothing but the Vodafone issue. And when does it arise? Now here we have a case of the target company, which is a foreign company. We have the sellers, which are again for non-residents. We have the buyers, again will be a non-resident. So this is a transaction between one non-resident and another non-resident for the acquisition of target company, which is also a non-resident. So there is no resident really involved. But the target company several layers down may have an Indian company. Now, if it has an Indian company several layers down, then we need to evaluate the indirect transfer implications. Okay. Now, when is the Indian indirect transfer implications triggered? First thing, we have to check whether an Indian company is there several layers down. Okay. If the value of the Indian company is at least 10 crores, okay, then the Indian indirect transfer implications would be triggered. Okay. The next aspect we need to look at is the value of the Indian assets vis-a-vis the value of target company. Okay. If the transfer of shares of the foreign company, which is target company in this case, derives its value substantially from assets located in India. Assets located in India is the Indian company in this case. Now, substantially has been defined to mean at least 50% of the value. So in this case, if let's say theoretically target company's valuation is 200 crores and the Indian company's valuation is, let's say, 110 crores, then indirect transfer implications will apply. While if the Indian company's valuation is, let's say, 40 crores, then it is not 50% of the target company is valuation, and hence indirect transfer would not apply. Okay. But here a couple of things are important. One is, in case if indirect transfer implications arise, okay, is triggered, then there is a withholding tax which gets applicable. So the buyers need to withhold tax on payments made to the sellers for the acquisition of target co. Okay, that is one. There are certain reporting obligations also. So, example, the Indian company will have to report the transaction, okay, to the Indian tax authorities. Lastly, the most important is the valuation. Okay. Now, to determine whether it is 50%, we will have to undertake a valuation. Okay? And even if 50% is not triggered, okay, but it is always advisable that we obtain a valuation report and keep it on the file, because tomorrow for such global transactions there can always be queries from tax authorities, and in such cases we can then substantiate that we've undertaken our due diligence, we've done a valuation of the Indian company, and the target company, and it is far less than 50%. So it's always advisable to have a valuation report in place. There is a valuation mechanism which is prescribed under the Indian income tax rules for valuation of the Indian company and the target company in case of indirect transfer. Okay. Now, presuming if the value of the Indian company is less than 10 crores, okay, then indirect transfer implications will not apply. Irrespective of the valuation of target company, there is a de minimis threshold which is provided in the statute, so that at least the small transactions do not trigger an indirect transfer. Now, another aspect which needs to be looked into for mergers and acquisitions is generally sale of content, which is generally a business transaction, sale of library. There could be, a sale of acquisition of, the entire library, which is nothing but content. And again, depending on the parties and how it is structured and how the delivery happens, the tax implications need to be evaluated. Next slide. Okay, so now we've discussed the key tax issues which really are prevalent in the media and entertainment industry. Now, just some of the put the concluding thoughts on the table. One is on account of the pandemic, the media and entertainment industry has been impacted significantly. The theaters have been shut. Okay, of course, the flip side of that is because of this, the business models have evolved, and really the digital transformation has accelerated. Okay, streaming has gained significance because of this. Cord cutting, which is basically, which has been prevalent in the US, has started in India. Cord cutting is nothing but discontinuing the television channels and the cable. We've seen this trend has started in India. Now the digital media has grown significantly. Digital media and online gaming are the fastest growing sectors in the media and entertainment space. We spoke about the global consolidations, acquisitions in the space. Now, in a matter of the last 3 years, we have 4 or 5 large global acquisitions and consolidations which have happened, which really have not been witnessed before. Okay, and this is nothing but because of the the disruption and the consolidation, disruption and the conversions in the space. Now, digital technology, telecom, media, there is an extent of convergence which is happening, and because of that, there have been consolidations. Content has been king and continues to be king. Moving to the regulatory side, the the amount of regulatory oversight or supervision continues to be a focus area. Okay, recently the Ministry of Information and Broadcasting notified the Information Technology Intermediary Guidelines and Digital Media Ethics Code. Now, because of that, there are certain compliances which need to be undertaken by social media, OTT players. So the regulatory space is evolving. The oversight is there in terms of OTT players and social media, and the compliances will only increase. Now, we spoke about content. The demand for content will continue to grow. The consumption is going to increase. Now, with the advent of 5G, this can only increase further. Lastly, the global trends in the digital for taxation of the digital economy. We touched briefly upon BEPS, which is base erosion and profit shifting. Okay, but the situation is globally evolving in terms of taxation of the digital economy. Several European countries, including Spain and France and UK, have introduced taxes on digital services. Okay, India has introduced equalization. In fact, India was the first country really to start with equalization levy. India has introduced equalization levy, significant economic presence, and the space for taxation of digital economy will continue to evolve and change, and one needs to keep an eye on this because the media and entertainment sector is going to be impacted by that. So I think that's it what I essentially had now from a presentation standpoint. If anybody has questions, I would be happy to take that.
Sir, I have shared the question as said, sir. You should have
Are you
received it.
sure? Okay, let me just have a look at the questions.
There are 6 questions altogether.
Yeah, I'm having a look. So the first question is, what if an Indian filmmaker sold remake rights to a foreign company and receives consideration in foreign currency? So here we are looking at a flip of what we discussed. Okay, essentially we have an Indian film has been made, and now that is proposed to be remade in a foreign language. Okay, now whatever the film producer is an Indian entity, and Indian entity is taxable on its global income. Okay, so even if the income is earned from overseas, he is going to be taxable on that. Okay, so the entire income would be taxable in India. Even if it's received in foreign currency, that's okay. It's going to be taxable on the full income in India. Of course, you'll get a deduction of if there is any costs which have been incurred for this purposes. Okay, you will get a deduction of that. But ideally, what would have happened is you would have already got the benefit. I believe the movie would have been published, already exhibited, and the entire cost of production would have been claimed as a deduction. So whatever amount he receives from sale of remake rights from the foreign company, he might have only a small amount of costs to claim as a deduction against that. Okay, now in case if there are any taxes which have been withheld in the other overseas country, because what would happen is the foreign company would make the payment to the Indian filmmaker, and in that country possibly local taxes would be withheld. So let's say, for example, if the foreign filmmaker is a US company, the US company would make the payment to the Indian filmmaker. If US taxes are withheld, okay, then the Indian film maker should claim it as a foreign tax credit in his tax return in India. Okay. Now moving on. The next question is a very interesting question. What's the reason behind the proration of the expenditure allowance as per tax rules when the release is less than 90 days from the closure of the financial year? See, Rule 9A was introduced way back in 1987. At that point in time, in 1987, if you see, the movies would run for several weeks. Okay, and they would earn revenue accordingly. From 1987 to now, times have changed. Okay, so if you ask me, I think the rules needs to be updated, uh, because today, if a movie is released in the last week of March, okay, the major revenues are earned in the first week itself. So the idea of prorating the allowance to 2 financial years in today's times probably doesn't make sense. The law has not changed. I mean, the only change which has happened is when 1987, when the law was introduced. I think it was 183 days or 180 days. From 180 days, it's been reduced to 90 days. Okay, so the law stands at 90 days. But with today's times, I think if the movie is released in the last week of March, the major revenues are earned in that 1 week. So maybe in the future the law needs to be relooked at, given today's times. So I hope the question has been answered, because when this rule was introduced, the revenue from movies was earned in multiple years, in more than 1 year, and that was the reason. In fact, as I said, the first time amortization for film production cost was introduced way back in 1937. At that point in time, a mechanism for 3 years was prescribed. Okay, because the revenues was not earned only in 1 year. You will remember the movie Sholay, which was 1975. It ran for 4 years. Of course, it was a blockbuster, but typically out there, the movies which were blockbusters ran for more than a year. Okay. So that was the logic which the government had prescribed. So the next question is transfer of copyright of a film, including sale of distribution, exhibition, digital rights, and all other rights for a period of 99 years does not amount to royalty, and whether TDS provisions apply under 194J. Whether 2020 amendment overruled the Madras High Court in case of Bhagya Lakshmi. So prior to this amendment of 2020, there were several decisions. As rightly, Bhagya Lakshmi was one decision, as rightly said. Majority, there were decisions of Time Warner and a lot of other decisions were there. Majority of the decisions were in favor of the taxpayer, though there were decisions which was against the taxpayer also in terms of withholding tax implication. Okay, prior to 2020. Now, post 2020, there has been a specific amendment. Okay. Now, if we look at what are the implications and what was the practice followed prior to 2020, essentially earlier, uh, theatrical revenues TDS was not withheld, and TDS was withheld on the non-theatrical revenues. That was the practice which was generally followed. Okay, to avoid litigation. Now it has been removed from royalty and it has been brought under 194J. Now, given this situation, it's going to be very difficult to still argue that TDS does not apply based on the decision of Bhagya Lakshmi, because that decision was under a particular set of facts and law which was applicable at that point in time. Post that, the royalty definition has been amended. 194. So there is an amendment to section 9, and there's an amendment to 194J. So going forward, I think it becomes very difficult to say that TDS would not apply. And then you can say TDS of 2% should apply. So The next question is more on the planning side. I mean, I'll just read it out. Being tax compliant as well suiting business need, how can we plan when there are multiple projects being between a content creating team with different funding teams, as creating multiple entities for each product is tedious job. Now, the tax essentially always has to follow business. Okay. If at the planning stage, okay, you need to have a structure in place so the funding needs are met. Now that will really depend on the facts of each case. How is the funding being arrived at? For example, a particular investor will come in only for a particular movie. So there are various aspects to be looked at. Now, at times, we might not have an option but to create multiple entities. But then there are ways and means where we can map funding with the business and keep the number of entities minimum. At times, AOP could be an option, and it could be structured appropriately so that the tax consequences are not adverse. But this really will depend on the facts of each case, as the structure that has to evolve would be different in each case. It cannot be the same. It entirely depends on the facts of each case. Now, the last question is, there is a practice of making payment for dancers, stunts, etc. through union. How to deduct TDS on the individual participants under 194C? See, in this case, we need to first see there are two things. One is payment flow is one, but contractual arrangement is the other. Now, is a contractual arrangement with the individual dancers, stunt artists, etc., then it gets our responsibility to withhold tax on payments to them. That's one. Now, worst case scenario, if taxes could not be withheld, we can always fall back on the proviso to section 201, which says that as long as the payee has has filed its return and paid appropriate taxes, the adverse consequences, that is disallowance under 40A, then 201, penalty, etc., should not apply. The only consequence that might still apply would be the 2011A interest from the time of payment till the time that the return of income is filed by the payee. Okay, but this, having said, this is only a fallback option. Ideally, you need to ensure that the taxes are withheld. If your contract is directly with the dancers, stunt artists, you need to ensure that you have withheld the taxes. So, any further questions are there, Selva? I have answered the.
Those are the questions. Nothing more than that. So, Pandaraj, over to you, sir.
Yes. Thank you, Prashant Bajwani sir, for this special job on a special topic, and that too for maiden attempt. So I thank you very much for your time and your specialization in this exclusive area. So many other beyond income tax, there are so many other aspects also to be looked into, and that you have highlighted to the members who have participated. I thank you very much on behalf of SIRC for this your time and your sharing of knowledge. And also, I thank all the delegates who have participated in this webinar and made use of this special topic. And also, I thank the chairman for choosing this topic and the SIRC office for supporting the conduct of this program and the technical support from Mr. Selva. Thank you all. Stay safe, stay healthy.
Thank you.